Oil markets are bracing for volatility after joint U.S.-Israel strikes on Iran raised fears of wider conflict in the Gulf. Traders are closely watching the risk of supply disruption from a country that produces roughly 3.3 million barrels per day, about 4% of global output. The bigger concern lies in the Strait of Hormuz, a critical maritime corridor through which nearly 20 million barrels of oil flow daily, equivalent to about 1/5 of global consumption. Any disruption there could sharply tighten supply. Analysts warn that without de-escalation, prices could jump another $10 to $20 per barrel when markets reopen. Iran remains a top 10 global producer despite years of sanctions that cut output from nearly 6 million barrels per day in the 1970s to current levels. Its production costs as low as $10 per barrel makes its crude highly competitive. More than 80% of Iran's oil exports go to China, making Beijing particularly exposed to any disruption. Meanwhile, the threat of a Hormuz blockade, even if temporary, could increase shipping costs, insurance premiums, and reroute global supply chains. Attention now turns to OPEC, which is expected to meet soon. Reports suggest the cartel could increase output quotas by around 137,000 barrels per day. However, analysts say any supply boost may only marginally offset rising geopolitical risk premiums. As traditional markets closed for the weekend, price discovery shifted to crypto-linked derivatives platforms. Perpetual oil contracts surged more than 6%, while gold and silver contracts jumped between 5% and 8%. Bitcoin fell as much as 3.8%, and roughly $128 billion was erased from the total crypto market capitalization in a broader risk-off move. With crypto trading around the clock, digital assets became a proxy hedge for geopolitical risks.